Hello, it's Robert Miner with Dynamic Traders Group with this week's DT 5-minute update and trade strategy for our Twitter and YouTube followers. We're going to take a look at a couple of markets very briefly. If you like what you hear and like what you learn, check out my book, High Probability Trading Strategies, and check us out at dynamictraders.com. You might be interested in ongoing analysis and trading education with one of our DT reports. Okay, let's get started. Let's take a quick look at the ES and follow up from last week. I gave you some signals that, if made, indicate that we're in a bearish trend, at least for the next few weeks. Those triggers have been met. Those signals have been met. Here's the weekly data for the ES. We've closed below the weekly close from the week ending January 3rd, this past week, and that it confirms the weekly top that I talked about last week. And in that case, we should be sideways to down in the stock indexes until at least the first week in March. The first week in March is the 38.2% time retracement. That's the typical minimum time retracement. If the market's making a correction, we may be having a higher time frame correction or a higher time frame bear trend. But what I always look at when reversal's been confirmed, what's the probable minimum time, the minimum price for the new trend? And in this case, minimum time, and keep in mind that's the minimum, is the first week in March, and the minimum in price is the 50% retracement, and that's at 30.96. So that's 50% retracement from the October low. And again, this is the first time since the October low that we've made a weekly momentum bear reversal and then followed up on it the following week with a decline below the overbought zone. That's really significant. So keep that in mind. We got about 4 to 5 weeks sideways to down at a minimum. Here's the daily data. And I'll just show you a few levels that you should be aware of, is that we've completed a 1 or a 2 or B, and it's probably a 1 and a 2. And if that's the case, the typical target zone on the downside for the wave 3 would be 31.30 down to 30.96. That's 162% alternate price projection of waves 1 or A, and that's the typical target for a wave 3 and maximum target for a wave C. Right below Friday's low, 31.94, is 100% alternate price projection. But if we're going to be sideways to down into early March, at best, this would only be a short-term low. Our 13 daily momentum's oversold, almost oversold, and the 8 is bullish. They're mixed. That represents basically a consolidation period, but it also indicates we'd probably be sideways to down for 2 to 3 days and then make a daily low, but any rally would be a correction within a bear market. But here's the key zone. Right now it's a really wide zone, 33.30 all the way down to 30.71. Wide zone. That's a real key resistance. If this market is just making a correction from the October low, this would be the maximum downside. We'll be able to narrow that range significantly in the days or weeks ahead. But that would be the maximum. If we exceed that area, and we'll talk about that in the weeks to come, if we do that, then we're in a much higher time frame bear trend. Here's the 240-minute data. Just a quick look at that. The 100% alternate time projection is Monday, the 3rd, and the 162% alternate time projection is Wednesday, the 5th. So we should complete a daily low by Wednesday, the 5th. And again, on the daily charts, we saw that our daily momentums were near oversold. So that itself told us we're 2 to 3 days from a low. And now the alternate time projection into Wednesday, that would be probably the maximum before we complete a daily low, and we have a correction that lasts at least 3 to 4 days. So that's what to expect, and that's, of course, going to happen this upcoming week. But again, we got a 1 or a nice ABC. We took out the wave B low, and as far as that matter, the wave 1 or A low indicates that wave 2 or B is complete. Now we're making a wave 3 or C. And because of the weekly position, it's probably a wave 3. So this is Gold Weekly. In the last week or two, I've been warning subscribers that the upside is probably pretty limited, and we're about to roll over, complete a weekly high, and then be sideways to down for 2 or 3 or 4 weeks. Nothing's changed with that. I realize over the last 2 weeks we've been slightly higher, but it's struggling on the upside. It's not an impulsive trend as in a bear trend. It's more like a correction. Here's our weekly data. Weekly momentums have been do a look back, overbought for 2 weeks. And here's what I suspect it's going to be similar to. Go back into what I got labeled as a wave 3, this area, about halfway up, where we went essentially sideways for 4 to 5 weeks before the bull trend resumed. And I think that's what's happening now, similar to this area in our momentum, because I've been saying all along that this is just a correction. We haven't completed this wave 5. We got longer to go. It should go into March eventually. When we finish this sideways period. So it's not a buying time. We look at the daily. This is corrective in nature, more than likely at least. And again, this is probably an A. We're probably making a B. I can put these in here like so in Elliott wave terms. And we'll probably make a C that's going to test or exceed this January low before the bull trend gets underway again. So I realize we've gone up. This past week, I didn't anticipate. I thought I shouldn't say anticipate. This high on Monday, the 27th, was in the ideal position to have completed an ABC correction, but we've just been sideways since then. But we're rolling over. I expect we'll roll over here this coming week and be sideways to down for a couple weeks before the bear trend or bull trend continues. So for our subscribers, the day that we have the signal for the bull trend, we'll let them know that. So I hope you'll subscribe and check us out daily. It's a pretty cheap subscription for all the daily information you get and weekly trade tutorials. Let's take a look at one more market before we wrap it up. This is Euro Daily, so there's something I want you to be aware of if you happen to trade the euro or the dollar. And if you're a subscriber, you would know that this past week, we were in the ideal position to complete an ABC correction. I mean, ideal time, price, pattern, momentum. Everything was in place, and we had the buy signal on Thursday. We had actually double buy signal there, so there was no ambivalence about it. We traded above Wednesday's high, and we even closed above Wednesday's high. So our Trade Alert subscribers were long as of the close on Thursday, and boy, wasn't that a nice timely entry spot. And I actually did a trade tutorial on my own trade setup where I went long that day as well. I sent that tutorial out during the day on Thursday. And boy, look what happened on Friday. What a big up day. So that's looking good. Daily momentums are bullish. They're not overbought. We should be sideways up for 2 or 3 more days. But here's what I want you to be aware of. If we make a close above one spot, 11,041, that's the January 9th close. That'll be a closing overlap. It'll signal that this should be an ABC correction. And what follows a correction? Resumption of the trend to a new high. We should eventually then continue to advance to above the December high. So that's the main thing to be aware of in the days ahead, in the next few days. And that is probably, if it's going to occur, it's going to occur this coming week. So it'll be a very significant longer-term signal I want you to be aware of. That's it for today. Check out our DT reports at dynamictraders.com and get an ongoing practical trading education. Take care. See you later.